Okay. All right, so the quiz, we've had, how many more quizzes? I think we only had 10 quizzes. Yeah. I'll think about posting some extra practice problems, problem set section from Bodie, Kane, and Marcus, the 11th edition. If you have a different edition and you think that maybe they're not lining up, let me know. But these are the ones that I thought were most useful. I tried to incorporate in this deck the concepts from the textbook that I thought were most relevant, most useful. So I will do my best. So we're going to return to, I've already talked about this before, economic theory versus prospect theory. I'm going to revisit it. I'm not going to do the survey questions, although they are on these slides. I just copied those slides over for reference. And the chapter in the book, the chapter is very short. It's only 2 sections. And I find their technical analysis section to be very lacking. So I'll go through some things that are probably on the slides, more pertinent in terms of the class materials. And then if there are no other questions, I can just kind of go through and walk through a few things, just looking at what's available in the public domain in terms of, if you're interested in technical analysis. I'm not a market technician. I don't pretend to be. I find it kind of interesting, although sometimes I find it a little bit, I don't want to use the term silly because that's not fair to market technicians. There are lots of people who are market technicians that I, highly respect. But that's kind of the plan for today. So I don't think we'll take up the whole time. Although I've said that before, and then I ended up talking the whole time. So I'll do my best. All right. So a review again: utility curve in economic theory, which the world of finance, the finance side of things. Actually, what is financial market activity and pricing theory? That's really very strongly based in economic theory. And in economic theory, there is this utility curve. It's a mathematical way to describe an individual's preferences. And it can be mathematically structured so that it's based off of consumption of goods 1 and good 2, good X and good Y, good or good 1 through good 1000. You can also construct it so that it's a function of income. And you can actually get there by doing these very advanced mathematical techniques. When you start with the utility curve of good 1, 2, 3, 4, however many goods you have in your basket. And when you do that, you tend to find a few things. First of all, this utility function as a function of income is always increasing. It's always going up as you earn more income. In mathematics, they call that monotonically increasing. It only increases as you increase income. It's never zero. It's never flat. It can get flatter, but it always is increasing. The slope of this curve decreases. In calculus speak, the first derivative is always positive. The second derivative is always negative. All that means is that there's a bow to this curve. It increases at a decreasing rate. I'll go through this again a little bit more slowly this time because I think I sped through it last time. In graduate economics, when I took graduate economics, the first thing we did was this in my microeconomics theory classes. You have a gamble. You have an outcome where you're either high outcome or low outcome. And let's just say that we have these utilities associated with this. I have this value of benefit that I ascribe to a low income level and a high income level. Of course, my high income outcome, I feel a lot better. And let's say that it's a pretty equal gamble. So my expected utility is simply the midpoint of these two. And if I draw that line, see the midpoint of these two outcomes, and I go all the way over to the line that connects incomes, that tells me my expected income. But at my expected income, if I were to earn my expected income with certainty, see if I can get this to work, I would be up here. I would be much better off. Instead, I'm here. That income level that's associated with my expected utility is something that economists call certainty equivalence. If I offer you this gamble, high income, low income, or on the behind door number 2, I will offer you this income with certainty. I can guarantee you, you will get this income. You will be indifferent between the gamble and that certainty equivalence income. So what if I just increase it by just enough to say, okay, well, what if I guarantee you that plus 1 cent? Oh, well, without extra cent, that'll put you over the top. It's all set. So I just need to offer you a slightly larger amount than your certainty equivalence. Notice the difference here. That is going to be what I call, I should not call profits, revenue, net revenue. Like Cambrian math. There we go, much better. Insurance company's net revenue. So an insurance company essentially takes premiums they're going to pay out some of those premiums for the claims. But that difference, if we had a risk neutral, what it's called, so this would be a straight line instead of a curve, that there would be no opportunity for insurance company to make positive net revenue. They would be paying out all of their premiums and claims. So this is the wiggle room that insurance companies have to play with, the average difference here between certainty equivalence and expected income. That covers their administrative costs, their operating costs, and their profits. So this actually does a good job of explaining a lot of things that, in theory makes sense and in observed behavior makes sense. They do a fairly decent job of describing how we as individuals and consumers behave. There is some nuance that gets missed, and this is where those behavioral psychologists come into play. Daniel Kahneman and Amos Tversky, who came up with their idea, which later became called prospect theory, where when things are positive, when things are positive income related, they agree with the traditional view of economists. It's shaped like that. There's risk aversion, but they don't call it risk aversion. They use terms like loss avoidance, regret avoidance. And more common parlance, you would call it FOMO. But they also have this interesting aspect on the downside. And this is where we've talked about this before. So I'm going to skip ahead a little bit. I'm not going to use this example of the gamble, because does anyone not remember this example that we did several weeks ago? Or that might be a couple months ago now. If there's anyone that wants to go through this now, raise your hand, enter it in the chat, let me know. I'm happy to do it, but you can also just watch the, I think it was the risk and return video. So I'm going to skip through these, but they're here again for you to look at. Okay. This example, and this is an example that actually predates Kahneman and Tversky. They did, I don't know if they came up with it in parallel fashion, but the president of the American Economics Association, which is probably the most prestigious economics association, in, I believe it was the 60s. I can't remember the economist's name, but he was the president for several years. And he had this paradox where he would ask economists, who, if economists believe in the idea of rationality and understand it fully, they should also make decisions that themselves that are rational, according to their rules of rationality. And he would ask them these series of questions. In an AEA meeting, he did this. And it was similar to what you see here. And through these series of questions, would you prefer an outcome where you have a 95% chance of this or that, and a 5% chance of that? He would change around the probabilities. And then he would put up on a screen and say, okay, it appears that some of you have answered in an irrational fashion, and let me show you why. And he would work through the math. And it's all about the fact that when you frame things differently, I frame it as a loss instead of a gain. I attach a higher probability to the zero, winning nothing. It can make people switch from being risk averse to what's called risk seeking. That's framing. If I frame the problem differently and make it look different, even though it's the same thing, it's very likely that many people will change their answer. A really classic example, a study psychologist, I think it might have been, I can't remember if it was Amos and, Kahneman and Tversky or not, but they essentially had separated, their subjects, group 1 and group 2. Group 1, they gave them a lot of questions with, some of them had like some pretext to it. One of the circumstances was there is a disease which is a very high fatality rate, 99%. There's a drug that might cure it, but if you give the patients the drug, there's a 90% chance that the patient's going to die from the drug. So that's group 1. Group 2. There's a disease that's very fatal. It's like 98, 99% fatality rate. But there's a drug that if you administer the drug, did I say that 10% survive? 10% will die? If you administer the drug, 90% will survive. 90%, it will save 90% of them. And you might not think that that would have an impact on the way people answer, should I administer this drug or not? But it did. And you can play around with the percentages to make it more or less, disparate, have a greater impact. That's framing. If you frame it in a way that makes it sound negative, even if it's the exact same problem or dilemma, on average, you will have people that change their response, that respond differently. And these are all studies that are not in perfect control, because it's not the same person. It's groups of people that are randomly assigned. And can you, if you assume that they would have the same response to the same framed question, is there a difference if you simply frame the question in a different way? That's framing. All right, so whenever I talk about behavioral psychology, which is much more broader, behavioral finance is essentially a combination of finance and behavioral psychology. Same thing with behavioral economics. But this usually resonates with a lot of people. In the problems the examples that I gave, a lot of people switch, even though it's a very similar set of gambles, switch from being risk averse when it's, facing the potential for gains versus being risk seeking when you're expecting losses. Because you could, well, there's that chance I would lose nothing. I would owe nothing. And that's exactly what this is trying to get at. How do you behave? How do you make decisions when you have limited amount of time to make that decision and you're not thinking, every single thing out? We act with bounded rationality. We only have a limited amount of cognitive ability. Doesn't matter how smart someone is, there is always going to be a cognitive limitation. We take shortcuts. And those shortcuts can sometimes lead us to what economists would call suboptimal decisions. There are three big heuristics. It's what they call the shortcuts. Availability. So what's most available to you, and this is where something called a recency bias would be important. Representativeness. Ignorance of sample size. Well, this experience that I know happened is representative of what's most likely to happen. What if that instance that you're talking about is an exception to the rule, is the minority of the outcomes? We have anchoring and adjustment heuristics. In the textbook, they go through what they call their view of the behavioral critique. And they have two main points to it. They have an information processing point and the behavioral biases point. So information processing has to do with, we don't process information in a perfectly rational way. We take these shortcuts because we have bounded rationality, because we don't necessarily always have enough time to go through and really truly think about everything. And then there's the second part, which is even if an individual, an investor, is given all of the information that they need, they're still going to run a high probability of coming to a suboptimal decision because of their behavioral biases. So some jokes about options accounts. Yes, options are expensive. Sometimes it's better to write them than to buy them. Actually, it's usually better to do that. All right, exercises and experiments. I would like for you to get a piece of paper handy, a blank sheet of paper. I'll give you a few seconds to do that, a minute or so to do that. And I'm going to put on the screen 10 things. And I want you to get, and they're numerical, but I don't show you the answers. And I want you to not look at the PDF that's on the site. I want you to do this in earnest, because I want you to really understand. So I want you to write down a 90% confidence interval. So I want you to write down a low number and a high number that you feel 90% confident that the true answer is in that range. There are 10 items that I'm going to show on the screen. I'm going to give you a limited amount of time to guess. That means that if you are 90% confident, you should only get one wrong. You should only have one where the true answer is outside of the range that you wrote down. Now, some of you may actually have specific knowledge about these. That gives you an advantage, but hopefully I've done a good job of finding things that you don't necessarily have specific knowledge about. They're just random facts. It's not an IQ test. I know these, or at least I've seen these so many times, and I still oftentimes miss 2, 3, or 4 of them. So maybe that's a sign of my ability to remember the true answer. All right, I'm going to read them out loud. I want you to write down low number, high number, and then after I'm done reading them with pause in between each one, I'm going to advance the slide, and I want you to score yourself. How many did you actually get? All right, here we go. What is the average weight of a blue whale, the largest mammal on Earth? In what year was the Mona Lisa painted? How many independent countries were members of the United Nations in 2009? How many bones are in the adult human body? How many items were listed in the Library of Congress at the end of 2008? How long is the Amazon River? How fast does the Earth spin at the equator? How many transistors are in the iPhone 8 chip, the processor? It's called an A11 processor. How many military personnel deaths occurred in World War I? What is the air distance between Moscow and Nairobi? All right, I'm going to advance the slides. Actually, give me a second. Okay. As you're finishing up, tabulate how many you got correct. Or tabulate how many you missed. Did anyone get them all right? Did anyone have all of the ranges so that you got the correct answer in your range? I would be pretty impressed if you did. Someone got 3 wrong. Yeah, just enter in the number that you got wrong. There's no shame. I've had people get 9 of them wrong. The point of this is that we are, as people, we are horrible at guessing something we have no immediate knowledge about. And even though I said at the beginning, 90% sure, 90% confidence. I should have let you know I put it in metric and in pounds to begin with, but even though I told you be 90% sure, so that should tell you if I'm not very sure, I should put, really, really big ranges on it. We're still really poor at assessing and estimating things, even when we have specific knowledge. If we don't know the exact answer, we're still pretty bad. That has to do with our behavioral biases. And the Amazon River, I think that there's not really an exact number of exact distance of how long it is, because no one's exactly sure where the source begins. But one thing that people usually get, got to make bigger ranges, yeah. One thing that always sticks me, I always have to double check. Are there actually 4.3 billion transistors in the iPhone 8 processor, the A11 processor chip? There are 4.3 billion. Yeah. So those are examples from The Psychology of Investing. It's a decent book. I would recommend that you read it if you're interested in how someone uses behavioral finance and behavioral psychology as a lens through which to look at the way that we invest. There are lots of really good investing behavioral finance biases in that text, in that book. So it's not a very long book. It's pretty easy. But there are many different things that impact the blue whale. What was the blue whale? People are talking about the answers here. 5 to 10 tons. Was it that 20,000 pounds? Is that a ton? All right. So lots of different things, biases and biases and heuristics that lead us to have these problems, not being able to forecast properly. There's conservatism. You're too conservative in your estimate. You were too conservative in your range of what you thought was 90%. Anchoring. It could be something that is completely unrelated to what you're trying to forecast, but your forecast can be anchored by practically anything. Our bounded rationality, recency bias, what's most recently happened, which also would lead to an adjustment bias. Well, what was my last forecast? Well, I don't want to move it too much. So that would really, make me look bad. That's intentional. There's also unintentional recency bias, which is listed right there. Or adjustment bias. Availability, what's most easily for you to recall that is most similar to what you're trying to forecast or estimate now. Just do a web search of cognitive biases. You'll see a huge list beyond just the world of finance and behavioral finance. There's some interesting experiments that I always like to provide an example of. So Daniel Ariely did, he wrote a book called Predictably Irrational. It's a really good review of a lot of the studies in behavioral psychology. And there's a phenomenon that he really drilled into that I found really fascinating. And this is more just psychology, but he went on campus and he and his research assistants were just giving out candy. And they said, you take as many as you want, as many as you like. And he had a bowl in front of them. People could take whatever they wanted. But people would just be mindful. This is really nice. Thank you so much. It's really thoughtful of you to bring this candy during exam time. And, I just need a little boost. I'll just take 2. Thank you. Like little Hershey's Kisses or something. They go another day to another spot on campus that's similarly trafficked. This time, they didn't tell anyone that they were doing this. This time, they said Hershey's Kisses or whatever it was. It was like 5 cents for one. Take as many as you want. People switched their behavior because it switched from being an act of kindness to what he framed as a business or a market transaction. I'd like 10 of them, so I'll just here's 2 quarters. I'll take 10. Thanks. That had a change in their approach to it. It's a really interesting example that you did. The classroom mugs example is another one. This one actually is a little bit more relevant to the idea of markets and economics. In a large lecture classroom, they handed out to half of the class mugs. And at the time, they were like just cheap little mugs you could buy at the university store, the campus store, for $5, $7 a mug. And in this classroom exercise, they said, okay, those students who don't have mugs, you can buy the mugs from the students who have them. So the theory of economics is that there should be at some point a price at which the students who had the mugs would be willing to sell them, and the students who didn't have mugs would be willing to buy them. And so a marketplace should ensue. But what they found was that no one really sold the mugs because they weren't being offered prices that they thought were enough. And I think the average price was something like 2 times the actual cost of the mug. And the people who didn't have mugs weren't willing to pay that. They weren't even willing to pay on average, the actual price of the mugs. This is something called the endowment effect. The reason why it's called the endowment effect in finance is because if an individual inherits a portfolio, they have been endowed with a portfolio of investments, they have attached an emotional attachment to those investments, which may be related to the person from whom they received the portfolio. Another name for it is called the status quo bias. It's also related to what's called the disposition effect. I don't necessarily want to get rid of these investments. These are the investments that I've chosen. Daniel Ariely also took this when he got a job offer at Duke University, and he went there. When Duke was in the Final Four, he did essentially the same thing, but in real time, because students who want to go to the Final Four, they can get tickets at cost. They just have to pay for, they also have to pay for their trip to the Final Four. They camp out overnight. This is what they do at Duke, because it's probably what they do at every university. And when they award tickets, they start by just handing out numbers to all the students that camped out, and they randomly draw a number out of the pot, and they start awarding tickets for sale to the students, starting with that number, and they continue and then wrap around back to the beginning until there are no more tickets. And so Daniel Ariely and his research assistants, after the tickets were awarded, they surveyed all of them. And they said, how much would you be willing to sell your tickets for? Oh, you didn't get a ticket. How much would you pay to buy that ticket? And the difference in the prices was staggering. It was something like 10 times different. The students who got the tickets were asking 10 times what the students who didn't get the tickets were willing to pay. And there's a very famous paper called The Market for Lemons in Economics that essentially goes through the mathematics using economics assumptions that shows that no market for used cars under these assumptions should ever exist. So there's something wrong with our assumptions. But this has to do with things that are other than economic forces and forces of markets. I could go through all the ways that they justified, well, I wouldn't want to spend all that money to go, and this really close to finals, right midterm exam time. I've got all these term papers I've got to do, and plus, I'd be able to watch it better. I'd see more of the game and all the replays if I watch it on TV, and it's a lot less expensive. I mean, it's a huge cost. So they rationalize. Last two digits of your social security number. This is essentially a random number. There's a question in the chat. Hold on. Isn't the Market for Lemons paper also responsible for the race to the bottom model? I don't know. I'm not sure about the paper for the race to the bottom. Market for Lemons, I'll have to look it up. I can't remember who. It might have been Kenneth Arrow who wrote it. I can't remember. I'll have to do a search for it. But I'll see if I can get you an answer offline. Send me an email if you really want me to dig into it so I remember. Daniel Ariely did an experiment of last two digits of your social security number. Those of you who aren't, who are study abroad students, social security number is just an identification number. The last two digits are random. There are some meanings to other digits, like the first few digits, but the last ones are truly random. So he said, write on a piece of paper, just put at the very top your name, last two digits of your social security number, only the last two. And then to his study participants said, okay, here are 5 objects that I want you to bid on. And I think I've mentioned this in the prior lecture. Tell me how much you would pay for them. And they're things that these college students wouldn't necessarily know the price of exactly. One was a bottle of wine, one was a wireless mouse and keyboard, etc. And then he compared the results based on the social security numbers. And he did it by looking at the top 20% highest social security numbers versus the lowest 20% social security numbers in the group. Large enough group, you're going to have a lot of 01, 05, 08, 92, 97, 96. By him asking them to do that, that anchored their thinking and had a statistically significant impact on the prices that they said they were willing to pay for all of the items. One of the items, it was as high as something like a magnitude of 10 times, maybe even higher. I can't remember the exact numbers. Apple or a candy bar. This is an interesting one because it also deals with something called hyperbolic discounting. The study participants came to the session on day 1, and then they returned back about 2 or 3 weeks later. There were one-on-one meetings, and so the study participants in one group were asked, "Oh, do you want a snack? I have an apple or a candy bar. Which would you like to have as a snack right now?" Group number 2. "Oh, you know what? Next time we're going to have snacks. Next, when you come back in 3 weeks. Do you want me to bring you an apple or a candy bar next time in 3 weeks?" They compared the results. They were different. People who were there and offered apple or candy bar had a higher rate of people choosing the candy bar. And the people who were coming back and people who were choosing their snack for 3 weeks from now, there was a higher rate of choosing the apple. I'm going to be healthy. 3 weeks pass, the study participants come back. "Oh, so I brought you your apple." And then the researcher would pull out from underneath the desk, "Oh, and I also have a candy bar if you'd like that instead." A significant number of people switched from the apple to the candy bar. It's probably not surprising. Similar idea, I think that Noob uses techniques like that, but it's actually not monkeys. It's actually, I believe they were chimpanzees, which they're apes, not monkeys. But peanut butter or popsicle. This is really interesting because it's not only a theory of markets, but it also shows that humans are not the only ones with behavioral biases. In a study, and it was a small sample size, but it was still, I think, revealing enough. The researchers gave the chimpanzees the tubes of peanut butter, and they communicated with them because they taught them how to communicate using sign language, and explained that they can keep the peanut butter tube or trade it in for a popsicle. And something like 30% of the chimpanzees traded in the peanut butter tube for popsicle. They let some time pass, and then they do it again, except this time they gave them popsicles. And so the revealed preference should be that 70% of those chimpanzees turn in the popsicles for peanut butter. There could be some variations where one decides to keep it, another one, some changes in personal preference just based on the day, but it should be a similar rate of preference. Well, turns out that instead of 60% returning the popsicles and trading for peanut butter, only about 35% did. It was almost the same. The same number of chimpanzees traded in, regardless of whether you started with a peanut butter tube or a popsicle stick. That's that same status quo bias prevalent in chimpanzees. I found that really interesting. Here is a long yet not comprehensive list of different biases that we have. I've talked about some of the anchoring, availability. There's one called the clustering illusion. Sometimes randomly clustered outcomes. You might think, oh, there's something similar about these, when it's actually just randomness. Confirmation bias is one that's extremely difficult to combat, to counteract. Gambler's fallacy. This is the idea that those of you that have been to, is anyone here that's been to a casino before and seen the roulette tables? No judgment. So when you're at the roulette tables, what's the thing that you notice the most? When you walk up to it, what's the first thing that's sticking straight up really high in the air? We'll save the roulette story for one. People losing money. Yes. There's a big pole, right? There's a big post with a lot of numbers going up the post, right? Have you seen those? You must have walked by it really fast. It's telling you all of the prior, something like 15 rolls, the 15 numbers that came up or something like that. But then you go in and say, well, yeah, so 3 came up last time, so it's less likely to come up now, right? That's how people, yeah, you're absolutely correct. The answer is no. It's equally likely to come up this roll as it was last roll. It's a memoryless game. But people do that. It's this fallacy of things that are in fact random or independent. We sometimes attach to it some relationship. By the way, if you kept it on 0, you would have made a ton of money. So, gambler's fallacy. House money effect. Sometimes when we get a windfall, like when you're gambling and you win a lot of money, you treat the money that you just won differently from the money that you initially posted. That's mental accounting right there. Oh, well, that's house money, and you take that house money that you won at the blackjack table, and you go over to the roulette wheel. Information bias. We're living in an age where we have access to more information than anyone can conceivably keep in their own memory during their entire lifetime. And so we actually think that we are better informed, even if we are given information that is absolutely useless. In Bodie, and Marcus, they go through several. Memory bias or recency bias. These are information processing parts of the behavioral critique. So memory bias or recency bias. We have overconfidence. We feel like we have too much confidence in our ability to forecast, estimate in the presence of uncertainty. Conservatism bias. We tend to not, adjust. Representativeness bias or sample size neglect. Confirmation bias, and this one I mentioned it earlier, it is pervasive in everything, even psychologists in academic journals. They created a group to try and root out confirmation bias by trying to replicate papers. And if a paper cannot be replicated, the author withdraws it. It says there was confirmation bias that led to these conclusions that cannot be replicated. It's actually a big problem, even in the hard sciences. There was even a big study by, I think it was Pfizer, maybe it was Bayer, but they actually tried to replicate papers. It was like 65 papers, and they could only replicate the results of something like 10 of them. Scientific papers done in labs. It's confirmation bias. Oh, well, this specific data point was tainted, so I'm going to throw that one out. There, that helps my results a lot more. The behavioral bias side of the critique. Making poor decisions even when presented with the real facts. Framing. The way that the data or information is presented can lead you to a different decision based on whether it's presented in one way or another. Mental accounting. A great example of this, I have a friend who, I think he actually has different savings accounts. Well, this is my travel money account. This is my savings for buying a home. This is my play money account. This is my money for going out with my friends. And you treat those accounts differently. College fund account, I'm going to put that in mostly high grade fixed income. Money for going out with friends, I'll put that. I'll buy some. I'll buy some Coinbase with that. If I've got some buddies that can always buy me some beers if I end up losing all that, so I'll buy me some Bud Light or something. Rather than taking a holistic view, what is my total exposure? What is my total expected return? What is the total risk that I'm taking across all of my accounts? That's an example of mental accounting in action. It's not the only one, but it's one that resonates in a class about investment. Regret avoidance. This leads to a herd mentality. I would feel better if I invested in Coinbase and everyone else is investing in Coinbase, even ARK Innovation ETF. Even if it loses money, I'm not the only one that lost money. I went along with everyone else. As opposed to if you were doing something like an unconventional investment and then you lost money, you would feel, gosh, that was so silly. No one else did this. Why did I do that? Even though it probably was not any worse or better of an investment. In Bodie, and Marcus, because the idea of this behavioral critique, that should mean that investors who are smart, diligent, and really effective at combating these behavioral biases and see mispricings should be able to arbitrage away these irrational pricings. But there are limits to what arbitrageurs can do. First of all, there's fundamental risk. And the best way for me to explain that is a quote from John Maynard Keynes. Yes, that Keynes. There's even a J.M. Keynes Drive in University City. This was from like 1930, 1920. Markets can remain irrational longer than you can remain solvent. Just because something's mispriced now doesn't mean that it's going to immediately revert back. The people know about, is anyone familiar with Black-Scholes? Fisher Black and Myron Scholes? They created probably the most famous in finance options pricing differential equation, and then Black-Scholes Merton. Black-Scholes Merton? I can't remember if there's a Merton Miller and then there's someone else whose last name is Merton. I think it's Merton. It's the Black-Scholes Merton model. It's an options pricing model. They won the Nobel Prize for it. Fisher Black and Myron Scholes formed together and were made a hedge fund. They paired with some people in hedge fund community to make long-term capital management. What they were doing is they noticed that a government's bonds would trade differently when they were what's called on the run and off the run. On the run is the most recently issued 10-year or the most recently issued 5-year. And then the off the run 10-year would be, well, this was a 20-year bond when it was issued, but now it's only 10 years from maturity, so it's a 10-year bond. The off the run 10-year from maturity bond traded at a discount relative to the on the run. So you buy low, sell high. So they short sold the on the runs and they bought the off the runs of the same maturity or very comparable maturity. The argument being, well, markets should be efficient and those prices should converge to each other. Well, in 1998, they were doing this with lots of different debt. So one of the sovereign debt that they were doing this trades with was Russia, or at the time Soviet Union. Soviet Union debt. And there were big disparities. And they thought, oh my gosh, we're going to make so much money once these converge. Well, they didn't converge initially. They diverged to the point where long-term capital management almost brought down the financial markets with it when it collapsed. And all the investment banks and big banks had to essentially step in and essentially save it to save the financial system. So even people who win Nobel Prizes are subject to these biases. Anyway. So fundamental risk. Implementation costs. There are costs to actually putting on arbitrage trades, things like bid-ask spreads. So there can be potentially what might be or appear to be market mispricings, but because of bid-ask spreads, you can't actually make money on it. Or if you're going to do an arbitrage trade, you're going to have to short sell something or go short something in some way, shape, or form, maybe through a derivatives contract. There are costs like basis risk or the fees for short selling securities. Model risk. This was a big problem in the 2000s with mortgage-backed securities and collateralized mortgage obligations. And some examples of what should have been similar, they're in the textbook, so I won't go through them, but the Siamese twin, that's the phrase they use, but Royal Dutch Shell merged, Royal Dutch and Shell Oil merged together in the 90s, and their prices were on shares on two different exchanges, and so the relative share of the company that those securities represented should have persisted in their relative prices, but they didn't. There was a discrepancy. And they go through and show, well, that discrepancy got way worse before it got better. So if someone actually tried to arbitrage that discrepancy, they would have essentially lost their capital before it actually reversed. They do an equity carve-out example of 3 common palm. They talked about the closed-end fund discount. Now they have an equation. I don't think it's useful to do that equation, but there is a very long history of closed-end funds, which were precursors to ETFs. They just had a fixed amount of shares in the marketplace, and they were managed funds. They traded at significant discounts to their values, net asset values. Any questions before we do technical analysis? Let me see really quickly how many slides I have here. I don't think I have that many. I only have a few, so if everyone's okay, does anyone need a break? Do with 5 minutes. All right, let's do a 5-minute break. We'll come back at 7:40 and we'll go through technical analysis. Hopefully it only takes us 10 minutes. I spent a lot of time going over the quizzes, so that's part of the reason. And then I'll entertain questions if there are anything on the materials, and then I can talk about just broadly technical analysis that I will not expect you to know for the exams. Okay. All right. I'll go ahead and get back to it. So in the textbook, they have a very, very short amount on technical analysis. And let me just make sure that I don't have anything sensitive up. Okay, here we go. All right, so they talk about a few things, Bodie Kane and Marcus too. But they talk about them very broadly. So they talk about momentum and moving averages. And I didn't see specifically where they called out the MACD, which is probably one of the most commonly used moving average convergence divergence. I think they call it an oscillator. They talk about something called the point and figure chart, and they explain it on page 267, where if you look at it, let me get a picture of a point and figure chart. So essentially what you need is that you have it's just trying to figure out, breaks and trends. And it's really, again, this is not something that's scientific. Let me actually get a point and figure chart. Here's one. So they have these, 1 is January, 2 is February, where's March? I don't see March in here. It must have been behind one of these other numbers. 4, 5, 6, June is behind there. And they have A, B, C for October, November, December. But what you need to have happen is that a trend, the X's are up, O's are down. And so a downtrend occurs. This is really, it's peculiar, but the low of the second trend period is lower. Well, now we're on a clear downtrend. So then you don't want, you really need to have it confirm an uptrend by, okay, so downtrend, 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 X's are up, downtrend, X's are up. Okay, that's a signal of an uptrend about to happen. Because that second uptrend, that second mini uptrend was a higher high. And so the next downtrend, you buy it, and then the idea is, oh, okay, well, then we made money. They're really peculiar. I have a friend and colleague, and mentor of mine, who used to joke, he said, well, I feel like we're just making stuff up, so I think we're doing it right, when he was talking about technical analysis. But there is something to it. But these are the ones that are listed in the textbook. So point and figure, that's a point and figure chart. Market breadth is used as a technical indicator. Is the sell-off broad-based, or is it just being driven by the FANG Plus companies? So that's Facebook, Apple, Amazon, Netflix, well, Alphabet, what used to be Google, Microsoft, oftentimes included in that, Alibaba. Is it being driven by just some of the largest cap companies, or is it broad-based? There's relative strength, and they use it as a ratio of, let's say you take a ratio of transports index, the Dow Jones Transportation Index companies versus, let's say, semiconductors. What's the ratio of those indexes? Which one is showing relative strength right now? There's also something called the Relative Strength Index, RSI. And that varies, the way it's constructed is it varies between 0 and 100. And when you see that the value of the RSI goes below 30, that usually means it's oversold, so you look for an opportunity to buy. When it goes above 70 or 80, then it's overbought. You look for an opportunity to sell. So it's a form of kind of like a moving average. There's sentiment indicators that I mentioned. And first, talk about the trend statistic, which is volume declining divided by number of declining, divided by volume of advancing, divided by number of advancing. It's kind of a contrarian one. Because if there's a big sell-off, this would be very high. Okay, maybe I should buy it. There are confidence indexes, and they give the example of the ratio of the top 10 corporate bond yields divided by the average yield on the 10 intermediate grade bonds. Short interest, which again might be contrarian, right? As we saw earlier this year with the likes of companies like GameStop and Nokia. And for technical reasons, that actually can work sometimes. Another way of gauging sentiment, put-call ratio. Again, contrarian. If the put-call ratio is really, really low, not as many puts, lots of calls being bought, that might be a sign that there's a little too much speculation and the market is overly frothy. So these are the indicators that they call out within Bodekian and Marcus specifically. But they're not really, clearly showed. Point and figure charts, they show some point and figure charts, but it's just peculiar. I've never really particularly liked point and figure charts. But there are a lot of ways to get at, well, what's a level of support? What's a price level where you would expect to have some technical support from market participants, or they might start coming in and buying the shares once it hit that key level. There's also the chance that support might break down. So there's always the opportunity that, well, it's actually the support level broke down and it fell straight through it. So sometimes it's very, very frustrating to listen to people who are really, really, really into technical analysis and say, well, here's a key level of support. And so once it hits that, I would expect it to go up, but there's always a chance that that support level can just break down. And if it does, it's just going to keep on falling. So you're saying anything can happen. So there are some people who use technical analysis and are very, very successful. But it's also really easy to just use it as a crutch to like, oh, well, anything can happen. But there are some interesting things. So this is not in Bodekian and Marcus. But there are some interesting things. I mean, some of them are, it's difficult for me to decipher, but these are actually things that people do track using candle chart formations. And so let me actually pull some of them up. These are just the names. Doji, equal, open, and closed values. You'll see it. There's one called an abandoned baby reversal pattern. A Harami cross, a dragonfly doji, a gravestone doji, a hammer, an inverted hammer. Renaissance Technologies, do they run on technical analysis? They're a little bit more mathematically focused. And so, oh, what's the founder's name? I can see his face. So they were founded by people who are essentially math PhDs and worked in mathematics departments. And they realized, hey, we can just create these mathematical models and program them up so that it just trades automatically on our ideas and we can make a lot of money. Jim Simons. It's one of the, I think he's either the sole founder or one of two co-founders. He's retired now. He's handed it off. But they are historically much more about creating mathematical models. If there's a way to mathematically create something that actually uses some form of technical analysis to decipher trends that actually can consistently, more than 60% of the time, make a return, they're very likely to employ it. But these are shapes in a candle chart formation. So let's take a quick look. Here they are. This is one of the best sites I've seen in terms of looking at, well, what are some candle chart formation patterns? These are doji. The color of the bar tells you whether it moved up from open or moved down from the open. So open, high, closed, low. The line in between it tells you the entire day's range. A doji was where it closes essentially at the open. And so the shadow, or the day's range, can provide some insight. But for doji, they just kind of vary in length. So this looks like an inverted cross, or a simple cross, or a plus sign. But, these are examples that they cherry-picked. Shows a reversal pattern here. This is the abandoned baby. So a downtrend, gap lower, never recovers the prior day's range. It's almost like a doji right there, and then that would signal, according to the abandoned baby reversal pattern, a reversal in the trend. I don't know what the opposite of an abandoned baby would be, but it wouldn't be called an abandoned baby. A Harami cross. I don't really understand this one. A loving household. I don't know. It might be an evening star. I don't know. Dragonfly doji. Again, I'm not even sure exactly how you decipher this. long shadows. Apparently it's a powerful reversal indicator. Morning Star Doji. 3 candlestick pattern. Clear downtrend, candlestick with a long shadow. Next day is very narrow. Then it jumps up. Here's an evening star. What is this one called? Morning star, evening star. So sun rising, sun setting. You can see that they're a little bit peculiar. Gravestone Doji, this one here, or a reverse dragonfly because it's a dragonfly flipped. Again. These are long shadow patterns. They typically show, I'm not sure exactly what they show. There's another evening star. There's the hammer. Here, hammer. Now here's the funny thing. Hammers can have dual meanings. It can be a bullish reversal pattern, or it can be occurring during a downtrend. An inverted hammer. So a hammer is when the handle is hanging down, and you've got the hammer at the top. Inverted hammer is, upside down. There's also one called a shooting star, which I think is the same shape as a hammer. I can't figure out what a hanging man actually is, but they have one here. So these go on and on and on. Candlestick patterns are exceptionally popular for chart technical people. So there are lots of others. Just if you Google candlestick or whatever, Google web search candlestick patterns, you will have lots to look at. Whether it's useful, I have no clue. But there are other forms of technical analysis techniques. Here are a few. Parabolic stop and reverse. Trying to decipher a trend. Is it trending up or trending down? And giving it a level where if the price crosses that stop and reverse value for the day, now it's reversed. And the trend has now switched. It's kind of backwards looking, so you're not going to have a perfect relationship. Bollinger Bands. I can pull some of these up. Here is Zoom. Backward looking, essentially, let me get that out of the way. There we go. So if you look at the screen, kind of in the middle, you see the Bollinger Bands widen out. They're essentially backwards looking confidence intervals. And so when there's a big change in the price right here, it's a big change. Right around where the 3M is, just below that, there's a huge jump up. That increased essentially the backwards looking volatility tremendously. And so the Bollinger Bands widened out. This the second panel, the one that's right underneath the price graph, that's the MACD, moving average convergence divergence. You have a slow one and a long one. And so when they cross, that's usually a sign of a trend reversal. They cross when they're low, then that means it's a potentially upwards trend reversal. It's going to trend upwards now. When it crosses out, when they're high, then it's usually a sign that the trend is now going from upwards to downtrend. Do hedge funds and large institutional investors basically have control over short-term price movement? Not so much. There can be broad market movements that could be initiated by potentially one hedge fund or one institutional investor. But something that we saw a couple of weeks ago with Archegos, that's likely going to result in some findings of wrongdoing or significant fines and restrictions on handling of money ever again. So those are mistakes. There's been a lot of regulation to prevent that kind of thing. Here's RSI, and let me actually pull up relative strength index. There we go. There's actually it's an interesting formula. So you can usually, if you know the technical indicator you want to look at, just look it up in Wikipedia. There's usually a good one to do. And this is, by the way, anyone who wants to drop or wants to interrupt me and ask questions, this is the time to do it. This is more for just understanding what technical indicators are. So they use different moving averages. They essentially trying to figure out, let's see, it's how many times is it moving up above its prior high, or is it moving down below its prior low? And so when it's high, that's a sign that it's overbought. So here it's 84. Usually 70 is the demarcation. When it's above 70 or 80, and it's subject to what the investor wants to do. That's usually a sign, oh, you should probably look to exit your position because it's been overbought. It's not to say that it cannot move higher. It absolutely can. I don't know what fractal chaos was, but I couldn't remove it from the graph, so it's still there. Stochastics. Again, it's a sign when it's high, that means it's overbought. When it's low, typically below about 30, this one is 20 and 80, it means it's oversold. So when it's high, you should look to sell it. When it's low, you should look to buy it, buy the security. There are many, many more. There's one called an Arun oscillator. I don't understand how it works, but it's here. I think Arun in some, can't remember what language. I think it means sunrise. What was the one? Yahoo Finance has spent a lot of time adding these on here. I've never heard of a Gator oscillator. Ichimoku clouds. I have never understood how to. I had a student several years ago who tried to explain to me how this works. Don't know. Let me redo this. Let's do this. You need a company that's had a lot of volatility. I use Tesla because they've had a lot more volatility. Zoom has had a lot, but kind of a reset. Let's try and reset it this way. Just by quitting. That didn't work. I'd love to know how to fix this. No, I can't. Ah, there we go. Ichimoku Cloud. Again, I had a student who was really interested and thought it was great, but I'm not sure he even understood what it was doing. So there are all these lines on here. And apparently when you have a certain cloud formation, which is this green and red line, when there's a difference between them, that's a positive sign. But once it pierces the cloud, there's something about like, well, that might be a bad thing. And I mean, I don't understand how this works. So right here, oh, well, maybe don't touch it here, but then all of a sudden it shoots up. I really have no clue how to read this, but apparently some people really like it. So if you can decipher it, you can teach me how to use this. But one of these is just, the price minus essentially put on a lag. This one. Anyway, when you get too far into the weeds of technical analysis, you can sometimes just find yourself making things up. No extra credit. You get the benefit of knowing that you taught me something. I learn a lot from my students. So. Okay. Does anyone have questions? This has a very long bibliography. Any questions, comments, concerns?
That's just kind of a general question on technical analysis.
Sure.
So in theory, right, these have to have better than a 50% accuracy, otherwise no one would use them, right? Because,
yeah,
like, they have to be better than just a straight guess.
Yeah.
So,
I mean, that's the weird thing, is that people are trying to decipher market trends and where prices are headed, and sometimes they just justify just confirmation bias. They're justifying their hypothesis by using some kind of chart technical support, supporting evidence from chart technicals, potentially. I don't know, did that help?
yeah, I was just curious because like it does seem like there's so many of these different methods, and that implies that there's not one that's very good. And if there's not one that's very good, like they all have to be meeting a certain standard, or otherwise no one would use them. But it's also
Right.
kind of weird since there's so many.
Yeah, there are. There's a society. There's a Market Technicians Association, the MTA, and if you're interested in this, I would highly, advise you to go and do the MTA program, where you can become a chartered technical analyst. Chartered market technician, CMT. So just like the CFA Society, which is much more fundamental analysis, there's a market technicians society. It's really interesting. A lot of the people, not a lot, some people who start out and do CFA the CFA program also do the MTA, and so there is some crossover there. Some people completely turn their back on what they spent years doing to get their CFA designation, and spent part of their early career on, and they realize, oh, this is absolute garbage. I'm just going to do chart technicals now. I've met a few people who've done that. When you say you post practice problems, are they going to count towards extra credit? No, if I post practice problems, they're just going to be practice problems for you to help with studying. I think the ones that I've selected from the chapter should be sufficient. I'll go back through them and see if there are any that I want to add to it. But between those, there's a lot of problems that are recommended in the chapters already. There are the quizzes that you can go through. All of those should be plenty of material. So I think that you'll probably already be feeling a little bit overwhelmed if you haven't gone through them already. So. If no one has any other questions, then I will go ahead and stop the recording.